Evening, happy Friday to everybody. It's me, Dan. I hope you'll forgive the lack of editing on this video, but we've had a lot of the same questions again and again this last week, and I thought I'm going to do you a quick 5 minutes. I've got a timer at the bottom of the screen, 5 minutes on interest rates. Does it affect you? Why do they matter? And so on. So, my intention is that by the end of this video, you will understand what affects the interest rate that you'll pay on your mortgage. Does it make a difference? If your interest rate goes up, goes it down, does it really matter? Interest only. Can you save money by switching to interest only? That's something which certainly a lot of people's parents or grandparents may be thinking that's an option for you. If you just bought your first home, switch to interest only, it'll save you money. Is that a good or a bad thing? And if you're in rented accommodation, does it affect you? So that's what we're going to have a talk about in 4 minutes, 10 seconds left. What affects interest rates? Does it make a difference if they go up or if they go down to your mortgage? Interest only, can it save you money? And rentals, if you're in a rental property, does it affect you? Forgive me looking over here, it's where my notes are. Not got a great memory. First thing, what affects them? Interest rates are affected by the Bank of England base rate in the UK. A lot of mortgages are linked to the Bank of England base rate either directly or tenuously via the lender's standard variable rate. And generally, the Bank of England base rate is a good indicator of whether the cost of borrowing is going up or down. That's what underlies a lot of the interest rates that people are paying. The Bank of England's one thing. The Bank of England's base rate's one thing. The next thing is the cost of banks borrowing. Now, the cost of banks borrowing depends partly on the Bank of England base rate and also on what they forecast rates are going to be in the future. They'll borrow at longer term fixes for themselves as well, so they can then lend that money on to us. Recently, we've had the Liz Truss Kwasi Kwarteng budget, which pushed the cost of borrowing for banks up really dramatically, really quickly. So fixed rates went up really dramatically, really quickly. Now that seems to be calming down a bit. We were thinking maybe 6% in the next couple of years. Now I think maybe 4.755%. I don't know. I'm not an economist. I'm a mortgage advisor. But that has an impact. The cost of banks borrowing. Bank of England base rate, cost of banks borrowing. Next thing, your credit rating. That has a massive impact on interest rates. If you haven't paid your bills in the past, you're a higher risk to a bank. They'll charge you more interest. Even though you may think that's unfair because I was struggling in the past, I lost my job, why am I being penalised? You will be. The fairness of that is something for a longer video another day. If you've not paid your bills on time in the past, especially if it's recently, and especially if it's your mortgage, you're going to pay a higher rate of interest, which means that your borrowing will cost you more. Loan to value then as well. This is why we were giving people so much caution about buying with 5% deposits through the pandemic and more recently. If property values dip, your loan to value, that's the amount you owe versus the value of the property, your loan to value can go up and up and up until it exceeds the amount the property's worth. You buy a house for 100 grand, you borrow 95 grand, and then all of a sudden that house is worth 90, you're in negative equity, so you owe more than the property's worth. That's a massive risk for a bank because if you don't pay them and they repossess the house, they haven't got enough money to pay that mortgage off. So the loan to value, the lower that loan to value is, if you only owe half of what your property's worth, house is worth 100,000, you owe them 50,000, fantastic, you're a really low risk. That will mean you're a lower interest rate. That's what affects them. Bank of England base rate, cost of banks borrowing themselves, your credit rating, and your loan to value, the amount of the property's value that you owe in a mortgage. I've got 1 minute 40 seconds left. So does it make a difference? Yes, huge. Capital repayment, normal mortgages, if you're £150,000 over 25 years, if interest rate is 1%, you're going to be paying 565 quid a month. If you're paying 9%, you're paying 1,258% a month. Sorry, £258 a month. 565 quid versus almost 1,260 quid. Huge difference. That means over the term of the mortgage, if you were in some magical land where it was 1% for 25 years, 150,000 borrowing is going to cost you 169,593. So that's about 20 grand. If you own 9% for 25 years, it's going to cost you £377,000. So that's a difference of about £208,000. No, more than that. Yeah, £208,000. Huge. So, interest rates do matter. 34 seconds, we might go a little bit over. Interest only, can it save you money? Yeah, can in the short term. If you think about low interest rate environment, so let's say more realistically, we're perhaps at, well, let's not go realistic, let's go ridiculous. 1%. If you're paying 1% on your mortgage, an interest only, which means you're only paying the interest, mortgage will cost you 125 quid a month. 1% on the capital repayment, £565 a month. That's a whopping difference. You're looking at way over £440 there or thereabouts. However, The interest-only mortgage over the term, assuming you're going to want to live there, is going to cost you 187,500, which is about £17,000 more, £18,000 more than the total cost of the repayment mortgage. 1% interest only, 125 a month for 25 years, but then you've got to pay them back the 150 grand. 1% capital repayment, £565 a month, sucks to be you now, 169,593 over the term, if it just stays that same rate. So, can interest only save you money if interest are low? No. Overall, no. Monthly, yep. Overall, no. Higher interest rates, then interest only on that same £150,000 mortgage. I've gone way over the time. I do forgive you. I said 5 minutes. It's not 5 minutes. I'm going to aim for under 8 now. So 9% interest only monthly payments on a £150,000 mortgage over 25 years, £1,125. Huge, right? Massive difference. That's £1,000 more than if it was 1%. So 9% interest on your mortgage, 1,125 a month interest only. The difference then, remember, we were £440 more on capital repayment. That difference has dropped to 133 quid now. I'm not going to go into how or why now, but 1,125 interest only, 9%, 1,258 if it's a 9% repayment mortgage. So as interest rates are going up, really common thing, can I switch to interest only and save money? Yeah, it'll save you a little bit, not really worth it. Then take into account your interest only mortgage for 25 years. You pay that £1,125 for 25 years. You've paid them £337,500 in interest, and you still owe them 150 grand. If you've got your 9% for 25 years mortgage on a repayment basis, you've paid them £377,637 in interest and repayments over that 25 years, but you owe them nothing. So for that extra sort of, what's that, 40 odd grand, you've paid the mortgage off. You don't owe them 150,000. That means the difference is £208,000 over the... Hello, Future Dan here. I've got to interrupt. I watched that back, thank God, before I posted it. I got my maths wrong. You don't pay them £200,000 more at all. You pay them £109,000 more. So massive difference. Interest only, 1,125 a month for 25 years. The interest, 337,500 at 9%, 150 grand for 25 years, plus £150,000. That's 487 grand, give or take. Repayment, 1,258, 1,259 over 25 years, that's 377. So now that is £40,000 more, I was right there, plus £150,000 you still owe them if it's interest only, compared to 337. That means you've actually paid £109,000 more if you have interest only at 9% on £150,000 over 25 years. You haven't paid them £200,000 more at all. So it is still way, 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 way worse. Just I'd read the wrong figure on my notes there. So can interest only save you money? Yeah. In the short term, long term, no. Don't go interest only on your home unless you've got a really good reason to do so. Then last point, as we're now 8 minutes in, I said I'm aiming for 8 minutes. I'm going to try and cut this down and edit. Rental, does it affect you? Yeah, because your landlord, if they owe money on the property, probably they've got an interest-only mortgage because their intention may be to make money in the short term, sell it in the long term. So they don't need to worry about paying back that £150,000 mortgage. We've just talked about 1% interest rates, interest-only mortgages, 125 quid a month, 9%, 1,125 a month. Realistically, your landlord over the last 5 years, if they've got a standard middle-of-the-range mortgage, would have been paying 3%, 4%, so 375, 400, £500 a month. Let's say that's 450. That's a fairly 450, £500 a month. Future Dan again here. Sorry to butt in on past Dan from a few minutes ago. Again, watching this back, I'd made another mistake on reading across these lines. So I was quite right. 3%, 4%, you're looking at about 450 a month on the interest only that your landlord will be paying. I then went on, as past Dan, to tell you that there's some incorrect figures. So let's say your landlord was paying 4%, makes the figures really easy. If your landlord was paying 4% a month on their mortgage of £150,000 on your beautiful home you're renting, then that would have been costing them £500 a month on their interest-only mortgage. So your rent's got to cover the mortgage and the cost of servicing the boiler every year and all the rest of it. And they've got to make allowances for rental voids, of course, and that sort of thing. But 4%, £500 a month. If that's doubled to 8%, which isn't far over what's realistic now for some other buy-to-let mortgages, that's £1,000 a month. 4%, £500, 8%, £1,000. Interest only is really simple. That's just what happens. The interest rate doubles, your payment doubles. Not the same for a payment. This we're talking about now, your landlord's mortgage. So, yeah, will it affect you if you're renting? Yeah, because your landlord, if they've got a mortgage, there's a really good chance their mortgage is going up really significantly and they're going to want to increase your rent. Probably not as dramatic as the mortgage. You would certainly hope not. And, yeah, it does have an impact, though. Anyway, thank you. Sorry, back to pass down again. Bye. That's a hell of a lot of information in 9 minutes 35. Let's just make it a 10-minute aim, shall we? I can do that. 20 seconds to say goodbye. What affects them? Bank of England, cost of banks borrowing, your credit rating, loan to value. Does it make a difference? Yeah. Does interest only save you money in the very short term? Maybe. Long term? No. Rentals, does it affect you? Yeah, probably will. That's it. Thanks very much. I'm Dan and my dinner's nearly ready. I'll speak to you soon. None of this is personalised advice. Give us a ring in the office if you want to have a chat. Bye, 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 bye.